Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, and today we are really jumping straight into the deep end.
We absolutely are. So the mission for today's deep dive is to look at some recent analysis of two massive shifts in global finance. And, I know this stuff can sound super complicated, but it actually affects everyday people. Like it affects you, the listener, right where you live.
Right. And it's the kind of stuff that just gets buried under all those scary financial headlines.
Exactly. So we're going to act as your shortcut today. We're looking at two big things. First, recent data shows some undeniable structural cracks forming in the $2 trillion U.S. private credit market.
Yeah, a massive, massive market.
And second, halfway across the world, Turkey's central bank just executed this massive, totally sudden sell-off of their national gold reserves.
Which, on the surface, those look like two completely isolated events, right?
Yeah, totally unrelated.
Like, you have a slow-moving credit issue in American corporate finance on one hand, and then a sovereign gold dump in an emerging market on the other. But when you look at the underlying mechanics based on the data, both are actually being driven by the exact same force.
And that force is basically a desperate systemic scramble for cash, right? For liquidity.
Exactly. A scramble for liquidity.
Well, let's start with the U.S. situation, because frankly, this touches on a lingering psychological fear for anyone who watches the markets. Whenever people hear about a multi-trillion-dollar credit market showing signs of stress, the immediate question is always, are we looking at the next 2008?
Right, the subprime mortgage fear.
Yeah, are we on the verge of another collapse like that? Because for a beginner investor, that's terrifying.
It is, and it's probably the most common fear out there. The 2008 crisis permanently rewired how we, perceive market risk. But if we look at the fall 2025 IMF Financial Stability Report, we get a really necessary reality check.
Okay, so how is today different from 2008?
Well, the mortgage crisis wasn't just caused by bad loans. Bad loans happen all the time.
Yeah.
The lethal factor in 2008 was that those bad loans were bundled into incredibly complex derivatives. And then those derivatives were held directly on the balance sheets of the core global banking system.
So the big banks were holding the toxic stuff directly.
Exactly. The traditional banks were so interlocked that one failure threatened to just implode the absolute center of the global economy.
Okay, let's unpack this with an analogy. So 2008 was essentially like a sudden massive heart attack that hit the center of the financial body.
That's a great way to put it.
Right. It stopped the whole body immediately, and it required this emergency room defibrillator, which was the massive government bailouts.
Yes, exactly.
But based on recent analysis, what we have now in private credit is more like high cholesterol. It's a slow-moving problem building up out in the outer arteries, kind of away from the core organs.
That captures the dynamic perfectly. The risk in the system hasn't evaporated, it's just relocated because of all the post-2008 regulations. In fact, Federal Reserve Chair Jerome Powell recently addressed this directly.
What did he say?
He noted that there are currently no signs of immediate systemic contagion threatening the major commercial banks. So the core is insulated. But in the exact same breath, Powell issued this stark warning. He basically stated plainly that, quote, people could lose money.
Wow. When the head of the Federal Reserve openly states people are going to lose money, you really have to look at who is actually holding the bag. If it isn't the big traditional banks, who is it?
It's the non-bank financial institutions, or NBFIs.
Okay, like who?
Well, after 2008, regulations made it really expensive and difficult for traditional banks to make risky corporate loans. So that lending activity just migrated into the shadows, into the hands of massive private asset managers, insurance companies, and pension funds.
Oh, I see. So they are the ones lending trillions of dollars to mid-sized companies now. But wait, I've read in the financial press that traditional banks are still heavily involved in this space. If they aren't making the direct loans themselves, how are they exposed?
Through a mechanism called back leverage.
Back leverage. Okay, explain that simply for me.
Sure. So a traditional bank might not lend directly to a risky, mid-sized software company. Instead, the bank lends a massive line of credit to a pristine, highly rated private credit fund managed by some Wall Street titan.
Right.
Then, that private credit fund takes the bank's money and lends it to the risky software company.
Oh, got it. So the bank feels safe because their direct client is this massive asset manager, but indirectly, the bank's money is still tied to the success of that risky corporate loan.
Exactly. What's fascinating here is how Reuters described this exact situation recently. They said the mounting stress in private credit is something that could be, quote, catastrophic, but not just yet.
Catastrophic, but not just yet. That's reassuring.
Right, because the risk is buried inside these opaque pension funds and private portfolios. A collapse wouldn't look like Lehman Brothers disappearing overnight. It looks like a slow, grueling decay of returns over several years.
Which goes back to the high cholesterol analogy. It's a slow burn.
Yeah.
And according to the data we're seeing, that decay is accelerating. I mean, recent Reuters reports highlight some pretty alarming data points.
Yeah, they do.
Like default rates in certain private credit sectors could jump to 8%. And a massive chunk of this pain is concentrated in software companies getting crushed by the AI shock.
Yeah, the AI shock is really the catalyst here. And the mechanics of that are critical to understand. For the last decade, private credit funds just loved lending to software as a service, or SaaS companies.
Right, because if you're a SaaS company selling, say, a customer service tool, your clients pay you every single month, like clockwork. It's highly dependable cash flow to pay back a loan.
Exactly. It was a sure thing. But then generative AI exploded onto the scene. And suddenly, a mid-sized company using that expensive customer service software realizes, wait, we can just build a custom AI chatbot for a fraction of the cost.
So they cancel their software subscriptions.
Right. The SaaS company's clients start canceling. Their recurring revenue plummets.
Yeah.
But here is the fatal flaw. The massive private loans those SaaS companies took out, they were mostly floating rate loans.
Meaning, as the Federal Reserve raised interest rates over the last couple of years, the monthly payment on those loans actually went up.
Exactly. So you have a software company facing a dual crisis. AI is destroying their revenue stream, while high interest rates are simultaneously driving up their debt. The math just breaks.
Yeah.
And they default.
And the domino effect travels right up to the private credit funds. I mean, we are already seeing heavyweights like Blue Owl limiting investor withdrawals. They are effectively standing at the vault door telling their own investors, you cannot have your money back right now.
Yeah, it's a textbook liquidity crunch.
And at the same time, traditional banks are looking at these rising defaults and starting to charge more for that back leverage we talked about. So the funds are getting squeezed from both sides.
They desperately need cash to manage their bad loans, but their access to cash is suddenly freezing up.
Okay, here's where it gets really interesting. If the private credit house is effectively catching fire and default rates are climbing to 8%, why did the stock prices of the biggest alternative asset managers, like Blackstone, Carlyle, and Apollo, why did they just suddenly jump up?
Ah, that is the million-dollar question, or rather the $10 trillion question. It's because of a potential regulatory lifeline coming out of Washington.
Okay, what kind of lifeline?
Under the current Trump administration, on March 30th, the U.S. Department of Labor issued a really consequential draft rule. This proposal aims to clarify and streamline the process for including private assets, specifically private credit, into everyday retail 401k retirement accounts.
Wait, really? Into regular 401ks? That is a staggering shift.
It is massive.
Okay, for the beginner investor listening, let's visualize this. Imagine a farming town with a massive reservoir that's been supplying water for a decade. But lately, there's been a drought, but the reservoir is drying up.
Right.
The private credit funds are that reservoir. They are desperate for fresh water, which in this case is cash. This new Department of Labor draft rule is the equivalent of the government proposing a new pipeline that connects that drying reservoir directly to the Great Lakes.
Yes.
The Great Lakes being the $10 trillion American 401k market. Of course, their stock jumped. I mean, they see an ocean of endless mandatory biweekly retirement contributions flowing their way.
Exactly. From the perspective of the asset managers, unlocking the 401k market is basically the holy grail. It's permanent capital.
Yeah.
But implementing this actually creates a massive structural collision regarding how liquidity works.
Right, and I want to push back on this a bit, because the mechanics here seem practically impossible. If I log into my 401k portal today, and I decide to reallocate my investments, or, I don't know, I face a medical hardship and need to withdraw cash, I expect that money to be liquid. I hit sell, and the cash is there.
Right. Usually in a matter of days.
But you just told me private credit involves loans that are locked up for 5 to 10 years. How can a daily liquidity retirement vehicle legally hold a 10-year illiquid asset?
You have identified the core friction of this entire initiative. You simply cannot offer daily liquidity on an asset that takes a decade to sell. So to make this work mechanically, asset managers have to build these really complex workarounds.
Like what?
Well, they can't put private credit directly into a standard mutual fund. Instead, they'd likely package it inside custom target date funds. And even then, they had to maintain massive cash buffers alongside the private credit just to handle everyday employee withdrawals.
Oh, I see. So if a bunch of employees panic and pull their money out of their 401k during a recession, the fund uses that cash buffer to pay them and just hopes they don't drain the buffer before the underlying private loans actually mature.
Exactly. And if the buffer runs dry, the fund has to sell its private credit loans on a secondary market, usually at a steep discount, which destroys the returns for the retirees who are left in the fund.
Wow.
So opening this door is an immense double-edged sword. Yes, it's just a draft rule right now, but it could unlock massive retail capital for these private funds. But the moment you put the retirement savings of everyday people, school teachers, factory workers, into complex, opaque shadow banking assets, you invite brutal political and social scrutiny.
Right, you can't operate in the shadows when you're holding the public's nest egg. Every fee structure, every default, it's all going to be under a microscope.
The industry would have to radically change how transparent it is, which kind of strips away some of the structural advantages of being private in the first place.
Man. Okay, so in the U.S., we're looking at private credit managers trying to engineer new pipelines to stave off a slow-moving liquidity drought. But what happens when a financial system faces an immediate, acute liquidity crisis?
That is a very different scenario.
Right, like a sudden five-alarm fire. We don't have to guess because we're
Yeah.
seeing it right now in emerging markets. That brings us to our second topic today, Turkey.
Yeah, transitioning from the slow cholesterol buildup in American finance
Yeah.
to an acute emergency intervention by a sovereign central bank.
And looking at the data, the behavior of Turkey's central bank over the last few weeks is a total mystery if you only look at historical trends. Because for years, Turkey has been a massive buyer of gold, right?
One of the biggest in the world.
They've been hoarding it alongside countries like Russia and China. It looked like a permanent strategy. But suddenly, they have completely reversed course.
And the sheer velocity of that reversal is what really caught global markets off guard.
Yeah. The numbers from the Reuters analysis are truly staggering. Turkey dumped roughly $3 billion worth of gold almost immediately after a regional war broke out. We are talking about their national gold reserves plummeting by over 118 tons in just 2 weeks.
Unbelievable volume.
That is a 14% drop in their entire national stockpile, completely liquidated in 14 days. And on top of that, global gold prices temporarily dropped by about 10% during that same window. So that wiped out an additional $8 billion in paper value from the reserves they still held.
It is a massive, painful hemorrhaging of national wealth. And to understand why a central bank would authorize a panic sale of their most prized asset, you have to look at the immediate existential threat facing their economy.
Which is what?
Turkey is in a desperate battle to defend the value of its currency, the lira.
And what exactly is pushing the lira to the brink of collapse right now?
It comes down to the mechanics of global energy markets. Because of the ongoing war and geopolitical instability, global oil and gas prices have spiked. And Turkey has a critical vulnerability here. They do not produce their own energy.
Oh, they import it.
They import almost all of it. And global energy is primarily priced and settled in U.S. dollars.
So to keep the factories running, the lights on, and the trucks moving, Turkey has to constantly acquire U.S. dollars to buy foreign oil.
Exactly. And if the Turkish lira crashes in value relative to the U.S. dollar, the cost of importing that exact same barrel of oil skyrockets in local terms.
Which creates imported inflation.
Right. The cost of fuel goes up, which means the cost of transport food goes up, which means grocery prices explode.
Yeah.
The central bank is basically forced to step into the foreign exchange markets, constantly selling their own dollar reserves to buy lira, just artificially propping up its value. But, a central bank only has so many dollars.
Okay, I have to stop you there because I hear the term orthodox policy thrown around a lot in financial media regarding Turkey, and I want to understand how it applies here. If they want to fix inflation, standard economic theory says you just raise interest rates, right? Why not just do that instead of panic selling their gold?
To understand that, we have to look at Turkey's recent economic history. For years, their leadership insisted on an unorthodox economic policy, They operated on this fringe belief that high interest rates actually caused inflation.
Wait, what? That sounds completely backwards to everything taught in Economics 101.
It was completely backwards. So while the rest of the world was raising rates to fight inflation, Turkey was lowering them. It was literally like throwing gasoline on a fire. The lira collapsed, and inflation soared past 60%.
Good grief, 60%.
Yeah. But recently, under the guidance of Central Bank Governor Fatih Karahan and Finance Minister Mehmet Simsek, Turkey finally surrendered and returned to orthodox policy, meaning standard textbook economics.
So they finally raised rates.
They slammed interest rates all the way up to a staggering 37%.
37%. I mean, for a U.S. investor, that is practically unimaginable. Imagine trying to get a mortgage or a small business loan to open a restaurant, and the bank quotes you 37%. It would completely freeze the domestic economy.
And that is exactly what it does. It grinds domestic credit to an absolute halt. They have pulled the interest rate lever as far as it can physically go. They can't raise rates any higher. But because of the spike in global oil prices, they still desperately need U.S. dollars today to keep the country running.
Which leaves them with only one option: liquidating assets.
Right. This raises an important question about how we view gold in the modern financial system. Because for the last decade, the popular narrative was that countries like Turkey, China, and Russia were hoarding gold because they wanted to de-dollarize.
Right, to escape the U.S. dollar system.
Exactly. But as recent market analysis like MarketWatch points out, this isn't a structural loss of faith in gold. Turkey's massive sell-off actually proves gold's ultimate utility.
I think the emergency fire extinguisher analogy fits perfectly here for a beginner to understand. For central bank, gold isn't a shiny museum piece to look at. It is the emergency fire extinguisher mounted on the wall.
Right, spot on.
You buy it, you maintain it, and you hope you never, ever have to break the glass. But when the inflation fire starts spreading, you don't use gold to replace the dollar. You break the glass, grab the gold, and sell it to get instant U.S. dollars. Because a dollar is the only currency that can actually put the fire out.
Exactly. Turkey didn't sell 118 tons of gold because they suddenly didn't like the metal anymore. They sold it because they needed dollars to survive the month. Gold is a highly liquid bridge to get you back to the world's reserve currency when you were locked out of normal credit markets.
So what does this all mean? We have explored two incredibly complex landscapes today. On one side, the slow-moving, high-cholesterol buildup in the U.S. private credit market, and on the other side, a sovereign nation executing an emergency gold fire sale. For the everyday investor listening right now trying to navigate this, how do we synthesize this data?
I think there are two foundational lessons here. First, regarding the U.S. private credit market. Don't look for a sudden 2008-style Lehman moment.
Right, it's not an overnight crash.
No. You aren't going to wake up on a Tuesday to find a massive commercial bank has evaporated because of bad software loans. Instead, watch the slow-moving pieces. Watch the back leverage of the banks. And monitor how insurers and pension funds handle rising defaults over the next 6 to 18 months.
Okay, and what about the emerging markets and the gold dump? What's the takeaway there?
The lesson there is how we fundamentally measure financial safety. Don't just look at a country's gross foreign reserves, the total raw amount of gold they hoard, and think they are safe. You must always look at their net reserves.
What do they actually have left after you subtract their immediate liabilities, like foreign energy imports?
Precisely. Because Turkey looked incredibly strong on paper with all that gold until the energy bill came due. The truly strong countries aren't just the ones hoarding the most gold. They're the ones who don't have to sell their gold when a crisis hits.
That makes total sense.
If we connect this to the bigger picture, whether we are analyzing U.S. private credit, searching for new liquidity in 401k, or a central bank dumping its gold to buy foreign oil, the real risk in finance today isn't about the assets themselves. A floating rate loan or a pallet of gold bars are just inanimate assets.
Right.
The real systemic risk always lies in the fragile funding structures holding those assets up. When the liquidity dries up, the structures crack.
Wow. Which brings me to a final, slightly provocative thought I want to leave you, the listener, with today. Just something to mull over on your own. Based on the analysis today, we see foreign central banks view gold primarily as an emergency substitute to get their hands on U.S. dollars.
Right, the dollar is still king.
But at the exact same time, the massive U.S. financial institutions that manage those dollars are looking at your everyday retail 401k account as their next permanent funding source to keep their private funds afloat.
It is a wild circularity in how capital flows.
It really is. Think about it. If the rest of the world relies on the U.S. dollar as its ultimate emergency fire extinguisher, And massive U.S. asset managers are looking at everyday American retirement accounts to provide their liquidity. Does that mean the everyday American's 401k is slowly becoming the ultimate final backstop for the entire global financial system?
That is a massive structural shift to consider.
It really is, and it might just be the reality we're heading toward. We will leave you with that to chew on. Don't forget to subscribe and hit that like button.